Edie's with FEMA Region 9, and we want to get the training on the website just so people who can't make it today can go back and kind of replay it and see what's said. This is Edie Lohman with FEMA Region 9, and we're lucky to have her today. FEMA Region 9 covers, gosh, Hawaii, Guam, the Pacific Islands, I think California, what else? A lot. Nevada. So you can imagine how difficult it is to get an insurance specialist from FEMA Region 9 out here within like 2 weeks of the new FEMA Insurance Reform Act getting passed. So what happened 2 years ago, 2012, and I know Edie's going to cover some of this, they tried to readopt the FEMA insurance stuff. It's called the Biggert Waters Bill. And it made a lot of changes, which were trying to bring rates up to regular actuarial insurance rates. And then into March, they changed it again and reversed everything and reversed a lot of things. So everyone's been kind of scrambling. And then on top of that, as you know, City of Maricopa is getting their new maps right in the middle of all this chaos. So we definitely wanted to have a good understanding here at the city of what the FEMA insurance means and what it means with the new maps, so that if you get asked a question from the public, you're giving them good information, and if you're not going to be able to grasp all the intricacies of the FEMA program, which I doubt, nobody does, at least know where to send them. So with that, I don't know if I introduced myself. I'm Elise Moore with Pinal County. Also here today we have Marine Town with ADWR, and Bruce Bender, who's one of FEMA's insurance trainers. He works as a consultant. And I will turn it over to Edie.
Thank you. Good afternoon. I really want to thank Josh and Elise and Pinal County for their flexibility and for inviting us to come over and talk to you about the National Flood Insurance Program. And I also want to thank Maureen Town and Bruce Bender. Maureen holds down the fort here in Arizona with respect to the National Flood Insurance Program, more or less, and she knows this stuff backwards and forwards, so it's a real pleasure to have her here in this session today. And Bruce is a consultant. He does what I do basically, but he's got a much broader wingspan. He does this all over the country and has a lot of contact with FEMA headquarters. So he has some invaluable knowledge, and I'll have these two jump in as we go through the briefing today. The flood insurance program, from all perspectives, I guess, is it's a wheel in motion, so to speak. So what we're going to talk about today, I know Pinal County is getting some new maps. We're not going to be talking specifically about the new maps today, but we're going to talk about the focus will be on what's changing with the flood insurance program. I'm the insurance specialist, so there's a lot of things changing in general with the program, and I'll give you a look at that from about the 30,000 foot level, so that you have a general understanding of the changes. But my area of expertise is the insurance, and that's really changing very quickly. So that's what we're going to focus on today. This is a little complicated, so these are some of the biggest changes that we've seen in the history of the flood insurance program. As we go through it, please ask your questions. This is a nice small group, and some of them we'll be able to answer. Some of them we will need to get back to you, because some of this story is, the ending of the story is still being written. So bear with me. I don't know what that was, but we're all okay. So bear with me as we go through the presentation today. What I'd like to do is, are you all community officials? Pretty much all community officials? else do we have? Lenders, agents, an insurance agent, okay. Any realtors? No realtors? How about lenders? And the rest of you are community officials. Okay, good. So ask away, and we'll do our best to get your questions answered. But let me give you a little bit of background about the flood insurance program as sort of a lead-in to the legislation, because I think it's an important piece of why the changes are being made with the flood insurance program. The National Flood Insurance Program is a voluntary program, so communities voluntarily agree to participate in the National Flood Insurance Program. They don't have to. So if they agree to participate in the flood insurance program, flood insurance is available to them through FEMA. FEMA oversees the National Flood Insurance Program. We're organized under the Department of Homeland Security. So it's one of many roles that FEMA has in the emergency management field. But when communities agree to participate in the National Flood Insurance Program, they have to agree to adopt FEMA's flood insurance rate maps, and they have to regulate how new construction and improvements are made based on those FEMA flood maps. And the FEMA flood maps are really important because the FEMA flood maps are going to identify where there's a low risk, a moderate risk, a high risk of flooding, and construction is regulated in those areas based on those FEMA flood maps, which are drafted between the local community and the FEMA engineers. They're also, the FEMA maps are also used for flood insurance rating. So the premiums are in large part based on the flood zone that the particular structure is in, which is on the FEMA flood insurance rate map. So that gives you just a little bit of a general idea about how the program works. There's actually three pieces to the National Flood Insurance Program. There is the mapping that I just mentioned. So the local participating communities work with the FEMA staff, the engineers, on identifying where there's a low risk, a moderate risk, a high risk of flooding. They put those on FEMA flood insurance rate maps, which are available publicly online. There's floodplain management piece of the program, and the floodplain management piece of the program has to do with how we build new structures and how we manage improvements or substantially damaged buildings when they are rebuilt. So that has to do with the FEMA flood insurance rate maps, because the regulations are dependent on what flood zones those buildings are being constructed in. And then we have the third piece of the National Flood Insurance Program, which is the insurance piece. And so FEMA agrees to make flood insurance available to communities who are participating in the National Flood Insurance Program. And as, excuse me, as I mentioned, the premiums are based in large part on the FEMA flood insurance rate maps. So those are the three main pieces to the National Flood Insurance Program, although there's a lot more to it. Legislatively, this program has not changed a significant amount up until this point in time. It was introduced in 1968 under the National Flood Insurance Act. So it's been around for a while. When it was originally introduced, it was a voluntary program. And an important note is that Congress introduced the National Flood Insurance Program as an alternative to federal disaster assistance. And the reason for that is because back in 1968, most of the private insurance carriers did not cover flood or flood-related damages. So there was really no way for property owners to purchase flood insurance coverage on the private market. So because Congress was seeing an increase in growing exposure to the number of flooding events and the consequences of the flooding, they wanted to have a program available for people to avail themselves to as an alternative to federal disaster assistance. So that was the National Flood Insurance Program. That's how the program got started. When it was introduced, I think it's important to note that Congress realized right off the bat that there were going to be existing structures that were already there when the program was introduced, and the existing structures were identified as being in high risk or special flood hazard areas, which are all those flood zones designated on the FEMA flood map as flood zone A's, as in Adam, or V zones as in Victor. So there was a certain amount of building stock that was older, and so they realized that those structures were at risk for flooding because they were identified as high-risk areas. But if they were to charge full rates for those buildings, because there were no regulations in place when those structures were built, because they predated the introduction of the program and they predated all of FEMA's flood insurance rate maps, those property owners probably would not be able to afford the flood insurance premiums that would need to be charged to make those risks actuarially sound. So they introduced what we call subsidized rates for these older buildings, which we call pre-firm buildings, because they predated the flood insurance rate map for communities that were participating in the program, and they were identified as being in high-risk areas. So they got subsidized rates. That's how the program was set up originally. So I think it's important to understand that. In 1972, Hurricane Agnes came along and basically wiped out the eastern seaboard. And what Congress discovered was that we only had 95,000 policies in force, and that the flood insurance program actually paid less than 1% of the damages from Hurricane Agnes, which I believe was $3 or $4 billion in damage. Not a lot by today's dollar value, but certainly a lot back then. So they said, wait a minute, it appears that people are not availing themselves to purchasing flood insurance as an alternative to federal disaster assistance. So they passed the Flood Disaster Protection Act in 1973, which essentially said that if you have a federally backed loan and you have a federally backed loan on a structure located in a high-risk area or a special flood hazard area, and those again are identified on FEMA's flood insurance rate maps as buildings in any of the A zones as in Adam or V zones as in Victor, then it would be incumbent upon the lender to require that borrower to carry a policy for flood insurance for the life of that loan. So the Flood Disaster Protection Act of '73 really was the impetus. That was the federal law that made it mandatory for property owners who have buildings in the A zones and the V zones, or the special flood hazard areas, to carry flood insurance. Because Congress felt that the FEMA flood insurance rate map, they spent a lot of money doing studies using the best available information to identify where these high-risk buildings were located, and they wanted to have some protection on these buildings for flood insurance. In 1994, they passed the National Flood Insurance Act, which updated the National Flood Insurance Program a little bit, and then subsequently the Flood Insurance Reform Act of 2004. So along the way, the idea was that as these older buildings, these pre-firm buildings in these high-risk areas that existed prior to communities having a FEMA flood insurance rate map where they were able to regulate new construction, that as those buildings expired, either because, let's say, they had a fire and they were rebuilt, or they were abandoned, or such, as new construction was built going forward, that new construction would be required to be built to certain floodplain management ordinances and standards. And so those structures would be less at risk to flooding, and therefore the flood insurance premiums would be based on their full risk or their actuarial rate. So for buildings that were constructed on or after the community had their first flood insurance rate map, which we call post-firm buildings, those buildings are generally, we find, 82 or 80 to 82% less likely to flood because they are built to current floodplain management ordinances and regulations, and when they do flood, they sustain 25% less damage. So those structures are less at risk to flooding in general, and the premiums that they pay reflect the lower risk because they are compliant with current floodplain management ordinances. So fast forward to 2005, and in 2005 we had Hurricane Katrina, Rita, and Wilma. We paid more flood claims in those three storms than we have in the entire history of the National Flood Insurance Program. When this program was set up by Congress back in 1968, it had to be authorized by Congress every so many years. And the idea is that it would be a self-funded program, and the policy premiums, for the most part, and the policy premiums that were collected would support everything to operate the National Flood Insurance Program, although the program did have and still does have borrowing authority against the U.S. Treasury. When the National Flood Insurance Program borrows money against the U.S. Treasury, it needs to be repaid with interest. So the National Flood Insurance Program is a line item on the budget just like everything else. So when we fast forward to 2005, we had to borrow money from the U.S. Treasury, and that put the program in $17, $19 billion of debt just from those three storms. So prior, though, to 2005, before Katrina, Wilma, and Rita hit, FEMA had been working with a lot of the academians, the meteorologists, who said, well, you know, what we predict, what we see is that in coming decades, you are going to see, because of the number of elements, an increasing number of flooding events, and you're going to see an increase in the severity of those events. So that was something that FEMA was aware of before Katrina, Wilma, and Rita hit, even in 2005. So they had been looking at the National Flood Insurance Program to see, before 2005, how it could be updated to maintain the solvency of the program and to make sure that it would be available for future generations, because even to date, we have very, very limited availability of flood insurance coverage through the private market. It's available, but it's limited and it's selective. Now, fast forward to October of 2012, while we had knowledge of all of that, and we ran into Superstorm Sandy. And Superstorm Sandy, of course, was a huge storm that hit and affected many, many, many states on the East Coast. It's a storm that we're still cleaning up from, and we're still evaluating some of the damages. So it's still underway. But that put the National Flood Insurance Program in even greater debt. So with that said, Congress, knowing what they had been told about the frequency of the flooding increasing, the severity of the events increasing, and the accumulated debt from the storms from 2005 and 2012, they were looking at the program saying, wow, we still don't have a lot of participation by the private insurance market, and that means that property owners, if they are not covered with a flood insurance policy through the National Flood Insurance Program or some other means, they're going to be relying on federal disaster assistance. Well, federal disaster assistance is, of course, taxpayer dollars, and it's limited. So thank goodness that we have federal disaster assistance, but it's limited in the form of loans and some grants and emergency repairs. But it puts people in a difficult financial position when they have to rely on federal disaster assistance. Thank goodness we have it, but it's not designed to make people whole, and it's also only available if for the most part, if there's a presidentially declared disaster. And we have flooding events all over the country 12 months out of the year that are not big enough events to be federally declared, where a full boat of federal disaster assistance is available. So that puts people in a more difficult situation if the event is not a big enough event for federal disaster assistance. So Congress really needed to take a hard look at the flood insurance program and look at a couple of different aspects, which we're going to talk about. So one of the things that the Biggert-Waters Reform Act did, it extended the authorization of the program through September 30 of 2017. And that's important because since 2008, we had experienced a number of short-term extensions and even some lapses in there where people couldn't purchase flood insurance, which was a hardship if they were buying a piece of property or a building that happened to be located in a special flood hazard area and they had a federally backed loan on it. They would be required to show documentation that they had a flood insurance policy in place, which they couldn't do if the program was not authorized. So we were happy to see that when the Biggert-Waters legislation was signed on July 6 of 2012 by President Obama, that it did reauthorize the program through September 30, 2017. So we have a little bit of time to work on getting the program revised. And although there's been a lot of media attention on the flood insurance premiums under the Biggert-Waters legislation that was signed on July 6, 2012, it's really an all-encompassing piece of legislation. And I want to share that part with you because there's really provisions in that legislation that impacts all three of those pieces that you saw on that earlier slide where we had the stool and we identified floodplain management, mapping, and flood insurance as the three main components of the program. So the Biggert Waters legislation recognizes improvements in all three of those areas, not just in the way that we rate buildings. There are about 13 provisions or more that talk about how can we improve the mapping. Let's use the latest and greatest technology that we have to improve the maps, to make the maps the best that we can make them, because as I mentioned earlier, the FEMA maps are a key component to the flood insurance program. We use them to regulate new construction, to regulate improvements. We use them to educate the public on what their flood risk is. We use them to determine flood insurance premiums. So it's important that they be as accurate as possible and using the latest and greatest technology that we have available. So there are provisions in the Biggert Waters legislation to do that. There are also about 18 provisions that deal with what we call risk reduction in studies. So the legislation calls for a number of studies, like affordability study, including building codes as part of floodplain management ordinances and regulations, which some communities and states already do across the country, and also risk reduction. FEMA has a number of grant programs that are available to local communities who have floodplain management projects to improve the flood risk in their communities. So the idea is to see how we can streamline that grant process to make it more accessible to the communities, to make it easier for them to apply for the grants, to get a hold of the money, to get it out to the individual property owners to make those improvements. So there are provisions in that legislation for that. There are about 18 provisions in the legislation that deal with flood insurance and how we rate buildings under the flood insurance program. And those are the ones that we're going to primarily focus on today. Out of the 18 provisions, under Biggert Waters, FEMA really had only begun to implement 2 of those provisions. One is called Section 205, and the other one is called Section 207. We had started to implement Section 205 January 1st of 2013, and we'll talk about that in just a minute. Section 207 was still being evaluated when this most recent piece of legislation passed on March 21st, which we'll talk about in more detail in a few minutes. So we're going to step back and we're going to talk about what was originally part of the Biggert Waters Reform Act that was signed by President Obama on July 6 of 2012 to make improvements to the program, because you really need to understand that in order to understand what the most recent modifications were. So, again, under the Biggert Waters Reform Act of 2012, which we call BW12 for short, so if you hear me refer to BW12, that just stands for Biggert Waters Flood Insurance Reform Act. FEMA started looking at 2 sections. One section is called 205, another section was called 207. So I'm going to tell you a brief synopsis about 207. We'll start with that one first. 207, let's do this. Section 205 and Section 207 address 2 separate categories of policyholders. Both sets of policyholders are subject to either subsidized premiums or significant policy discounts under the National Flood Insurance Program. And that was intentional. That was the way it was originally set up back in 1968. Section 205 talks about all of those older buildings, which we call pre-firm buildings, the buildings that are constructed prior to the community having its first flood insurance rate map, because each community elected to participate in the program at a different time. Therefore, their first flood insurance rate map date differs from community to community. So Section 205 focuses on the structures that were there already prior to the community having its first flood insurance rate map, or a pre-firm building that is in a high-risk area, a special flood hazard area, any flood zone that starts with the letter A as in Adam or V as in Victor, and also D as in David flood zones. Now, what is a D flood zone? A D flood zone is not a flood zone where there's a mandatory purchase requirement, but it is a flood zone where it's an unstudied area. So we really do not know what the flood risk is there. We haven't done a detailed study. And those policyholders in the older buildings, in the pre-firm buildings that are in D zones, also receive and have received historically in the program subsidized rates. So their subsidized rate is significantly discounted from what their full risk or their actuarial rate should be. So they're paying maybe 35% of what their actual full risk rate is so those people under Section 205. So those are the pre-firm subsidized policyholders in the A zones, the V zones, and the D zones. Section 207 is another group of policyholders who receive significantly discounted policies when there is a map change. So if they are, let's say, for example, in a low to moderate risk flood zone, or what we call a B as in boy, C as in cat, or X flood zone, where there's a low to moderate risk of flooding, and they get remapped into a special flood hazard area, into one of the A zones or the V zones, where there's a higher risk of flooding, and flood insurance will be mandatory if they have a federally backed loan. We have allowed in the history of the program for them to have discounted policies in the form of what we call grandfathering, traditional grandfathering, or preferred risk policy eligibility extensions. So those are the two groups of policyholders that are initially targeted under the Biggert-Waters legislation. So Section 205 and Section 207. Now, Section 207 was being evaluated under the Biggert-Waters legislation. It has since been repealed completely under the new Homeowners Flood Insurance Affordability Act that was just signed on March 21st of 2014. So Section 207 is not under evaluation anymore because the entire section has been repealed. So what does that mean? That means that policyholders who are subject to map changes are still eligible and will be eligible until we're told otherwise to have discounted policies in the form of grandfathering or the preferred risk policy eligibility extension. And we have a question. So
So that means that if they already have a PRP policy, they're eligible for extensions.
So the question is, if they have a preferred risk policy already, already, are they able to continue that? Is that your question? Yes. So they should be able to, and are you asking that question in reference to a map change?
Our maps changed in 2011, but the PRP window has closed. So if they may have gotten some sort of extension, then they're only able to extend it maybe again or something. But other than that, if their PRP window is closed after the map change, they don't have an opportunity to buy a PRP. Because we just had our map change in June 2011. So it's, it's past the window. So there's no PRPs available for us, correct?
Well, there should be.
Oh, there is?
Yeah.
Okay.
So the preferred risk policy eligibility extension remains. So, and you're specifically addressing that type of discounted policy. So if the preferred risk policy eligibility extension is available for anybody that is newly mapped from a B, C, or X zone into a special flood hazard area, an A or V zone or D zone, October 1st, 2008 or later. So if they were remapped from a low to moderate risk area, which is the BCX zone, into a special flood hazard area, an A zone, a V zone, or a D zone, then they would still be eligible for the preferred risk policy eligibility extension. Great question. Yes, so that preferred risk policy eligibility extension applies to people who were remapped from the low to moderate risk area to the special flood hazard area, newly remapped, October 1st, 2008 or later. And the reason that October 1st, 2008 date exists is because in 2004, FEMA started a map modernization program where we were digitizing the paper maps. For those of you that have been working in the flood insurance program for a long time, you'll recall that we had all paper maps prior to 2004. And then in 2004, we began to digitize those maps so that they were available for viewing online. And then in 2008, some of those digitized maps, we started to look at the maps and update the maps and do flood insurance studies in some areas. So we had people going out of floodplains, people coming in floodplains, but the largest percentage of those updated studies took place October 2008 going forward. So that's why we have that date implemented for the preferred risk policy eligibility extension. So although in the Biggert Waters, the original Biggert Waters Flood Insurance Reform Act, signed July 6th of 2012, those discounted policies were slated to be phased out over a period of time. That has now been repealed under the most recent legislation, which is the Homeowners Flood Insurance Affordability Act that was signed March 21st of 2014. So Section 207 and all of those policy discounts remain intact as it stands right now. But let's jump over to Section 205, because Section 205 did a couple of different things, and a couple of different things were being implemented and have been implemented already, and some of those changes will remain, and some of those changes have been modified or repealed under the Homeowners Flood Insurance Affordability Act of 2014. And this may get a little complicated, so ask questions, and we will again do our best to answer. Section 205 was a piece of the Biggert Waters legislation that FEMA began to implement July 1st of 2013. And the Biggert Waters legislation was very specific in identifying what categories of structures would have phased out subsidies or phased out discounted policies, and it also contained a specific timeline of when those things would occur. So FEMA was implementing that legislation as it was laid out, and it targeted under Section 205 pre-firm structures in the A zones, the V zones, the D zones that were non-primary residences, businesses, and 1 to 4 family severe repetitive loss properties, and any newly purchased policy or lapse policy after a certain date. So those were the real 4 target areas that came with changes under Section 205 that have already begun to be implemented. So we're going to focus, we're going to narrow this discussion down to Section 205 because you have to understand what those changes were under Biggert Waters and then how some of those may have changed under the new legislation, the Homeowners Flood Insurance Portability Act of 2014. So bear with me here as we go through this. Okay, so first and foremost, I want to be clear that under the Biggert Waters 12 legislation, Section 205, the changes or the rate increases apply only to the pre-firm subsidized rated buildings in any type of A zone, V zone, or D zone. AR and A99 zones are exempt. They are under a different statute. So when we talk about Section 205, we're not talking about the entire policy base. We're talking about only those policy holders who have pre-firm buildings, pre-firm subsidized rated buildings in the A, V, and D flood zones. So pre-firm, just to be sure that we all have that terminology down because it really is important as it relates to the legislation. The pre-firm structures are essentially those buildings that were constructed prior to a community having its first flood insurance rate map. So they were built before the initial flood insurance rate map date or on or after 12/31/74. Post-firm is any structure built post-firm, post-flood insurance rate map for that particular community. So just to give you some sample dates, these dates are, you can find the pre-post-firm dates on the map panels, on the cover of the map panels. It'll give you the original firm date, but they're also listed in what's called a community status list. And the community status list, if you Google National Flood Insurance Program Community Status List, it will bring up the community status list for the entire country, and you'll be able to look specifically, it's organized alphabetically by state, at the pre-post-firm dates for individual communities throughout the country, including all of the communities in Arizona. So if a community is unincorporated, it falls under the jurisdiction of the county. So I selected just a few dates that I thought might be of interest. Just to give you an idea.
So, yeah, interesting side note. She pulled that from the FEMA directory, and that 2007 date is incorrect.
You're going by the...
And, well, so what happened was City of Maricopa is a very new city, and when you guys got into the program, that date got put in there, and that's not the correct date. You guys actually had flood maps before you incorporated, so that date's going to get rolled back to probably '83. just so you know, because that's not accurate.
I like that, it's good.
But I don't want you to tell people they're pre-firm before 2007 because that indicates a whole world of things, and it's really going to be the 83 date probably.
So go by August 15th, 1983. And sometimes this occurs if the community is newly incorporated. Their pre-firm, post-firm date will be based on the county. So in this case, perfect, that's even better. So the pre-firm, post-firm date for the city of Maricopa will take as Pinal County's date, which is August 15, 1983. So what does that mean? If you have a structure that was built prior to 1983, then it is considered pre-firm, right? Okay, so if it was built in 1987, it is post-firm. Okay, and Section 205 under Biggert Waters applies to pre-firm buildings, because those are the buildings, if they are in high-risk area, the A zones, the B zones, or the D zones, getting the subsidized premium. Is everybody with me so far? This gets to be much more fun. Okay, so, yes ma'am.
I thought pre-firm was only if it was built before the 1974 date.
Okay.
So it's just pre-firm of the home date? It could be before 1983?
So let me see if I can make this more simple. Think about pre-firm. Think about pre-firm as being built before the community had its first flood insurance rate map, whatever that date is. I think that's the easiest way. I put the technical definition up here because that is the technical definition, but the 12/31/74 date just really confuses people, to be honest with you. So the easy way to remember pre-firm, post-firm is if pre-firm is any building constructed prior to the community having its first flood insurance rate map. Post-firm is on or after that date.
And I would just say in the city of Maricopa, very rare you're going to hit a pre-firm unless it's in the Old Town area. So, 99% of your structures are going to be the post-firm. So.
Perfect. Okay. So what did we begin to do on January 1st of 2013? Under Section 205, FEMA began to implement 25% annual rate increases for what we call non-primary residences that are, again, pre-firm. They're in A zones, B zones, or D zones. These are vacation homes, second homes, rental homes. These are residences that are not a primary residence, if you will. And technically speaking, that is a structure where the insured or the insured spouse will not live. They live there less than 80% of the year, currently. So if they live there less than 80% of the year, it's considered a non-primary residence, a second home, a rental home, vacation home. And it would be subject to the 25% annual rate increase each and every January 1st if it's pre-firm in an A zone, B zone, or D zone. Now, I want you to take a little bit of a note at the bottom of the screen, because if you look, it says that the 80% is going to be decreased to 50% effective June 1st of 2014. So coming up here very quickly, if the insured lives or the insured spouse in the building, in the residence, for less than 50% of the year, it would be considered a non-primary residence. So that's going to change June 1st. Okay, and the reason that we're changing the 80% down to the 50% is to put it into alignment with the way that the US tax system is based.
And I just wanted to say, primarily your customers that have investment properties in City of Maricopa, they're going to have these questions. So the percentage of occupancy is what you're looking at. How many months of the year are they here? And if it's over a certain percentage or under a percentage, it can really affect their rates. So we have a lot of people that invested in homes here from Canada and so forth. That's the people that are going to ask that question.
That's absolutely correct. So this is an important slide for most of our Region 9 states because we have all the garden spots, right? We have California, Arizona, Nevada, and so we have a lot of second homes, we have a lot of rental homes, there's a lot of absentee owners, so you may very well get calls from some of these residents saying, well, my flood insurance premium went up 25% January 1st of 2014, and on January 1st of 2014, what happened to them? Remember, these are annual increases, so they got another 25% increase on January 1st of 2014. So we are in April. So some of them have not seen their renewal bills yet for 2014. When they do, if it is defined as a non-primary residence that is pre-firm in an A, V, or D zone, they will see another 25% rate increase. At this time, there is no change that's going to be implemented as a result of the additional piece of legislation that was just signed on March 21st of 2014. So this piece of the Biggert Waters legislation will remain in effect. So the next implementation was put into place October 1st of 2013. And again, this 25% rate increase applies to a different group of policyholders, but it is impacting the pre-firm subsidized rated buildings in the A zones, the V zones, and the D zones, because that's what Section 205 targets, is those pre-firm subsidized buildings in the A, V, and D zones, the high-risk flood areas. So effective October 1st of 2013, 25% annual rate increases were implemented for businesses and 1 to 4 family severe repetitive loss properties that are pre-firm subsidized buildings in the high-risk areas and the D zones. So this could be another category of building that you'll see or get calls on, because these again are annual rate increases, and these are also staying. They're not impacted by the most recent piece of legislation that was signed.
And again, think Old Town City of Maricopa, where you got all those old businesses that have been sitting out there for 30 years or more. They're all in A zones. So those are the ones that are going to be faced with that.
25% is 25% of the premium that they're paying existing. Like if they were paying $600, it's another 150 or whatever.
It's 25% of their rate. So if it was $1 1 year, next year it'll be $1.25.
Okay. So it's not based on what they should be paying.
Well,
The difference of what they should be paying. It's what they are paying.
Right.
Okay.
And the 25% annual rate increases, one of the questions that comes up a lot is, well, how long will they incur 25% rate increases? At what point will those rate increases stop? The rate increases will continue until we can establish what the full risk rate is on that particular building. And how do we establish the full risk rate? on a building. We do that using more detailed underwriting information. We collect that information on a form called the elevation certificate. The elevation certificate is generally completed by a licensed land surveyor or a registered civil engineer or architect. And the property owner will obtain an elevation certificate and be able to provide that to their insurance agent, who will then provide it to the underwriters, and the underwriters will look at that additional detailed information. And what they're specifically looking for is how high their lowest floor is above the level that we're expecting it to flood to. And the level that we're expecting it to flood to is called the base flood elevation on a FEMA flood insurance rate map. So we want to see how high they're elevated above that expected flood level. And the higher they are elevated above that level, the cheaper their flood insurance premium will be. So at some point, it will be cheaper for them to be full risk rated based on an elevation certificate than to incur the 25% annual rate increases. And it will be up to the property owner to provide the elevation certificate to their insurance agent, so the insurance agent can keep that on file and use that to their benefit when they reach the point that it would be beneficial for the property owner. So a business property is any income producing business. So a business property is what you would naturally envision, but we don't specifically, or have not in the past specifically identified business properties on our applications. We identify them as residential or non-residential. Non-residential are usually what we call our business or commercial properties, but not every business is necessarily income producing. For example, a church or a nonprofit organization is not income producing, so they would be exempt from these 25% rate increases. However, if it's a business that is truly income producing, those are the categories of buildings that are targeted under this specific provision. So that's what we mean when we say businesses. 1 to 4 family severe repetitive loss properties. Those property owners generally know who they are. They have already been notified. We have been managing those properties using a special direct facility for a number of years now. They are those buildings that have incurred 2 losses in a 10-year period that exceed the market value of the building, or they've had 4 or more flood insurance claims over $5,000 each in a 10-year period. So that's the official definition of a 1 to 4 family or a severe repetitive loss building. This particular section of Biggert Waters targets 1 to 4 family severe repetitive loss buildings. So those structures that are 1 to 4 family severe repetitive loss, pre-firm in A zones, B zones, or D zones are subject to the 25% rate increase, and there will be no changes there. The 4th category also was effective October 1st of 2013, and because it falls under Section 205, it also applies to any pre-firm building, subsidized rated, that's in an A zone, B zone, or D zone, with the exception of the AR A99 zone. And this is not a phase-in of full risk rates. This provision under Section 205 says that if you purchase a new policy on or after July 6 of 2012, when the Biggert Waters legislation was enacted or signed by the President, or you let your policy lapse on October 4th, 2012 or later, when you get a new policy, you will be subject to full risk rates immediately. So what exactly does that mean? What that means is that beginning October 1st, 2013, anybody who, for example, would have purchased a pre-firm property in a special flood hazard area or a D zone would be subject to full risk rating, which means that they would be required to provide their insurance agent with an elevation certificate that showed the specific underwriting detail on that building, and the building would be rated using the elevation certificate. And again, we're looking for how high is the lowest floor built above the level that they're expecting it to flood to on the current FEMA flood insurance rate map. This presented some challenges because remember, pre-firm buildings are older buildings, right? So in the past, we've subsidized these rates, and the reason that we have subsidized these rates is because they were not built to any particular floodplain management ordinances or standards. Those regulations did not exist when they were built. They could have been built anywhere, anyhow, anytime. So essentially, what we uncovered is that about 50% of the pre-firm buildings in these A zones, B zones, and D zones actually benefited from having an elevation certificate. Their flood insurance premium turned out to be cheaper than their subsidized rate because by chance their lowest floor was higher than the current base flood elevation on the current FEMA flood insurance rate map. However, one of the unintended consequences was that the other 50% of the policyholders did not have lowest floors that were elevated to the base flood elevation or the level that we were expecting it to flood to on the current map. And so their lowest floors were actually below that level, which meant that they were at significant risk of flooding. And when those structures were full risk rated, those flood insurance premiums tended to be extremely high in a lot of cases, much higher than the subsidized premiums. So let's just take a look at an example. This is a pre-firm home. This house, we can say it was built in any A zone or any V zone that we want, but it's pre-firm. And so when the property owner goes and gets an elevation certificate on this structure, as you can see, it turns out that the base flood elevation, or the level we're expecting it to flood to on the current FEMA flood insurance rate map, is halfway up the side of the house. So that means the water is going to get up to that level in a catastrophic or base flood. But unfortunately, because this is an older home and we didn't have that information at the time, the lowest floor of this house is down here, right? So let's just say, for example, that the lowest floor is 4 feet below this level that we expect it to flood to with the best technology we have today. So it's a -4. That's what's recorded on the elevation certificate, and that's how it's rated. But the flood insurance premium can turn out to be as high as $9,500 a year on this particular property. That presented some issues. It presented some economic hardships for property owners that own these homes. Some people owned them outright and they went back to get a second mortgage or a home equity loan or something. Some of these property owners discovered this when they tried to sell their home, and the new owner was required to pick up a flood insurance policy because they were getting a federally backed loan to purchase the home, and they discovered that the flood insurance premium could be significantly more than they expected. So the other 50%, however, found out, well, you know, I'm elevated well above the base flood elevation or the level we're expecting it to flood to. And of course, this house is a real extreme, but I kind of wanted to drive the point home. So, you know, really the higher you're elevated above the level we're expecting it to flood to, the less likely you are to flood. We have those statistics. We know, you know, what they are, and we know what the likelihood is, and we know, you know, what kind of damage and what that's going to cost. So this particular structure, just by chance, pre-firm, elevated above the level, the base flood elevation, their flood insurance is significantly cheaper. Instead of paying the subsidized flood insurance premium for a pre-firm property in a special flood hazard area, which for maximum coverage would run somewhere in the neighborhood of $2,200, let's say, as a ballpark, based on today's rates. These guys could use their elevation certificate and benefit. They would actually only be paying about $427 a year. But, again, if we're dealing with the other 50% who do not have a house that meets the current elevation standards and they're in a high-risk area, then we're looking at some potentially high flood insurance premiums. And if this particular property owner was paying a subsidized premium before, somewhere around $2,200, $9,500 is significantly higher and is definitely going to prevent, you know, it's going to cause a hardship for most people. So what happened? Well, what happened is Congress became aware of these unintended consequences of having these higher flood insurance premiums being implemented on some categories of previously pre-firm subsidized rated buildings. And so on March 21st of 2014, after a lot of deliberation, they passed the Homeowners Flood Insurance Affordability Act of 2014, which modifies and/or repeals some of the provisions of Biggert Waters. One of the provisions of Biggert Waters that is being changed is the piece where property owners are full risk rated when there is a new policy issued on or after July 6 of 2012, or their policy has lapsed October 4th, 2012 or later. So now we are going to, FEMA's looking at the Homeowner Flood Insurance Affordability Act of 2014, and they've actually issued a bulletin yesterday, and it's Write Your Own Bulletin 14014, which is on our flood insurance reform website, which you'll see a snapshot of that in a next slide or two. Elise was nice enough to make several copies of this Write Your Own Bulletin. They are on the back table, and I encourage you to pick up a copy of the bulletin or look at the bulletin online. It is posted at our website, and I'll give you that address in a minute. But essentially, there are a couple of things that the Homeowner Flood Insurance Affordability Act did. One was, of course, repeal Biggert Waters Section 207, which was still under evaluation. None of that had been implemented, and that had to do with phasing out the subsidies for property owners who were remapped into special flood hazard areas from low to moderate risk areas. And also the Homeowner Flood Insurance Affordability Act now modifies the triggers that we had that would require structures to be full risk rated. And those were the policyholders that took out new policies on or after July 6th of 2014, or their policy lapsed October 4th, 2012, or later. So this is still a story that is unfolding. The bulletin, as I said, to assist the insurance agents and the underwriters to revert back to the pre-firm subsidies based on the October 1st, 2013 rates that were published, is still a product in the works. So the bulletin is dated April 15th, just yesterday. It came out yesterday morning. You have a copy of the full bulletin in the back of the room, and a copy of the full bulletin is also online for people who were unable to attend today. But essentially, what that bulletin talks about is what we call Section 3 under the Homeowners Flood Insurance Affordability Act of 2014, which says in a nutshell, although the bulletin's got a lot of detail in it, but in a nutshell what it says is that beginning May 1st, 2014, as these pre-firm policies that were full risk rated renew, or new applications are issued for these buildings that would have been subject to the full risk rating because it's a new policy or the policy lapsed after the enactment of the Biggert Waters legislation in 2012, that they will be reverting back to or reinstating the pre-firm subsidized rates based on the October 1st, 2013 rate chart, which is in the Flood Insurance Agent Manual. There will be refunds that will be issued to certain categories of property owners who were required to be full risk rated under the Biggert Waters legislation. We do not have the details on how that will be rolled out and exactly who will be eligible for those refunds. So we do not have that information. They are still working on that, but there will be additional right-to-room bulletins that will be coming out with some specifics on who will be getting those refunds. So with that said, we really, if you get calls from property owners or policyholders who are interested in this flood insurance reform legislation that was just signed on March 21st of 2014, and they have policies coming up for renewal, and they're curious about whether they should renew it or not, or whether they'd be subject to a refund or not, we really, really want to make sure that policyholders renew their flood insurance policies and keep those policies current. Because if they don't, lenders, regardless of whatever the National Flood Insurance Program is doing with their rating structure, the lenders are required under federal law to mandate that policyholders that are in high-risk areas and have federally backed loans have a policy for flood insurance. And if the policyholder does not show proof of flood insurance, then it is incumbent upon the lender to make sure that that loan has coverage. So we don't want to have a situation where policyholders hear about the legislation, they don't renew their flood insurance policy, they create a lapse in coverage, and a deliberate lapse in coverage, and then the lender subsequently force places coverage on them. Forced place coverage is usually done by the lenders outside the National Flood Insurance Program. So it is not normally a national flood insurance program force-placed policy, although it is generally a more expensive policy because it's force-placed and there's not the underwriting information there that we would normally collect to issue a standard policy. So that is really a key point. We want to make sure that policyholders continue their policies because we don't know who these refunds are going to apply to and when they will be rolled out. They're working on that now. So that's all the information I have for you on that part with respect to the refunds. Did you have something you want to add?
Well, I wanted to add, we've been getting a lot of questions from folks that are coming to the public meetings, what's going to happen? And I think Edie can tell you we don't know. And unfortunately, that triggers a really bad response from the customer when we say we don't know what's going to happen, but we're talking about Congress. So what we do know is that they will get their lowest rates if they get their policy in place before June 16th of this year when your new maps go effective. So we know that. They will get the lowest rates if they get their policy before that date. After that date, they may get the extended policy, but it's going to be higher. So when you get the question and they say, what's going to happen with Congress, you know, many people have tried to predict that in the past and there's just no telling. But what we can tell you is the lowest rate you're going to get is the one you get before the maps go effective. So in a year, we'll have a much better idea what's going to happen with everything else.
And I think that is, that's a key point in this whole process. Because you guys, in addition to all of these changes, these legislative changes with the National Flood Insurance Program, you have a map change that's going on, coming up here pretty quickly. So we want to make sure that people do understand that if they are being remapped into a high-risk area from a low to moderate risk area, that they can get the lowest policy by buying it before, and then we'll see what happens as we go forward. The phase out of the discounted and grandfathered policies for the remapping has been repealed under the Homeowners Flood Insurance Affordability Act, but we don't know what that future holds a year from now. So I think that's a really good point. So if you're curious, with respect to Section 205 of the Biggert Waters legislation, and again, these are the pre-firm buildings that are getting the subsidized rates in the A zones, the V zones, and the D zones. This will give you some idea for the state. The state of Arizona has a total of about 34,847 flood insurance policies. And that data is as of December 31st, 2012. So it stays generally in that ballpark in the history of, since I've been doing this, of 34,000 plus or minus policies. So about 2% of those 34,000 plus policies are impacted by the 25% rate increase because they are pre-firm subsidized non-primary residents, so the vacation home or the second home, in the A, V, or D flood zone. And I know you guys, you do not have V zones here. V zones are coastal, but at some point when California has the big earthquake, you will have oceanfront property. So then you might have some B zones here, but for now, but just to be clear, I include all of those flood zones that are impacted by the legislation. And also, about 2% of the 34,847 policies are the pre-firm subsidized businesses in the A, V, and D flood zones. So it's not a huge percentage of the overall total policy base that will be seeing these annual 25% rate increases, not as much as you would think. And that's mainly because we are targeting a specific group. So that specific group are those pre-firm subsidized buildings that are non-primary businesses or 1 to 4 family severe repetitive loss properties. Those are the 25% annual rate increase categories that will remain. So that's going to continue. With respect to others, about 13% of that policy base, which is about 4,635 policies out of the 34,847, are also pre-firm subsidized policies in A zones here in Arizona or D zones that would have been impacted if they took out a new policy on their building, or they let their policy lapse and then at some point going forward picked up a new policy. So that would have been about 13% of the policy base. The other 83% of the policies that we have here in Arizona, which is about 28,842, are not impacted or would not have been impacted by Section 205 of Biggert Waters as far as what we were implementing at the time. So just kind of gives you a little snapshot.
What percentage of Arizona has X policy?
I don't know that Edie can answer that. I mean, I think it differs. Like, I know for Pinal County area, we don't have a lot of detailed studied areas, and a lot of the rural counties don't. Maricopa County, many more detailed studies, so they're going to have more A zones. So it's not so much that the rural counties don't have floodplains, it's just that we haven't gotten to map them all yet.
Maureen, do you happen to have any feel for what percentage off? I mean, I have no idea without looking it up. The question is, what percentage of the area would be X zones, BC or X zones? Okay. Yeah. Okay. Well, right. The 83% are those policies that are BCX zone, or they are post-firm buildings in the special flood hazard areas that are already full risk rated because they're post-firm, so they were required to be built compliant when their permits were pulled. So they're already paying the full freight, if you will, or the full risk. So they're already paying their actuarial rate. So overall, it's not a huge impact, but for those people who are impacted, there are some significant, or could have been some significant economic consequences. And just to give you an idea in the region in general, these are all the states that FEMA Region 9 handles. This gives you an idea of where you stand in the region as far as percentage of policyholders who would be impacted as a result of the provisions under Biggert Waters Section 205. And this includes all the provisions that I just talked about that we were implementing under Section 205, the 25% rate increases, as well as those property owners who could have been impacted by the full risk rate triggers for the new policies and the lapse policies. Wait.
Maybe you had that up there. And I don't know, Elizabeth, that this answers it or not, but about a third of the policies that are in Arizona are in Zone X. So we do have people who are getting those policies, which is great to see.
Good. Thank you, Bruce. That's helpful. So if you're curious about what the composition is of those policyholders in different areas of Arizona that would be impacted by the 25% rate increases that will continue to be implemented under the Biggert Waters Flood Insurance Reform Act of 2012, we have a really good GIS map on the website. And you can go on to the website. If you type this website address in, it ends with BW12, and that stands for Biggert Waters 2012. The actual website, it will get you there. It will get you to the flood insurance reform website, but because we now have Biggert Waters 2012 and we have the Homeowners Flood Insurance Affordability Act of 2014, we've changed the name of the website just to say flood insurance reform. Flood insurance reform. But if you type in this address, it will get you to this GIS map. And if you look at the map, you can actually type in a community in the upper right-hand box, and it will allow you to zoom in, and it will give you some detail about the impact. And there's some census data in there as well. They did a really good job. So you can kind of get a snapshot of the impact of Section 205 on particular areas throughout the country. So as soon as the Homeowners Flood Insurance Affordability Act of 2014 was signed, immediately a Write Your Own Bulletin came out. Now the Write Your Own Bulletins, if you're curious, are directed towards the insurance carriers who are partnered with FEMA to get the policies out to the general public, because we don't have an 800 number that property owners can call to get a flood insurance policy. They have to go to a local insurance agent to get the policy issued. So FEMA partners with 90 plus private insurance companies to get the policy out to the general public. So these bulletins are directed towards the Write Your Own, we call them Write Your Own companies. These are the private insurance companies that are offering flood insurance through the National Flood Insurance Program to property owners. And all of the bulletins now and going forward, and all of the old bulletins from the Biggert Waters legislation are on the website, which I think is our next slide. Here's the website, and this is the new website address. So if you type in BW12 instead of flood insurance reform, it will get you there, just the same. We just changed the ending because we have now 2 pieces of legislation that we're looking at. So I'll give you a minute to write this down, and I really want to stress that if this is a work in progress, all of this legislation, major changes, a lot of it's still being evaluated. We have a lot of implementation that's going to be done going forward. So this is going to be a long process. It is probably going to be extending more than a year, probably several years going forward. The best thing that you can do for yourself and the property owners who call you with questions about these flood insurance program changes with respect to the legislation is refer them to this website, because the website is going to have everything posted there, and FEMA has really done an outstanding job of keeping this website up to date on a daily basis. As soon as the information is vetted through the Write Your Own companies and external affairs and so forth, it's posted on this website. So if you go to the website occasionally, once a week or whatever, you're going to get the latest and greatest information that we have available. And we're asking people to be patient because the Homeowners Flood Insurance Affordability Act of 2014 that was just signed on March 21st is making some significant modifications and changes to the original Biggert Waters 2012 legislation. So we did a whole national outreach focused around the Biggert Waters 2012 legislation to all of our stakeholders, the congressional offices, the community officials, the agents, the lenders, the realtors, to the public. And so now we're going back, and we're going to have to go back, and we're going to have to update those stakeholder groups as the information becomes available with the Homeowners Flood Insurance Affordability Act of 2014. So stay tuned for these additional bulletins that will be coming out, because there are a lot of provisions under the Homeowners Flood Insurance Affordability Act of 2014 that modify the Biggert Waters legislation. I am not at liberty to discuss anything additional at this point in time because it's still under evaluation. So all of that will be posted on the website. But just in summary, the 25% rate increases under the Biggert Waters legislation will continue for the pre-firm subsidized buildings in the A zones, V zones, and D zones. If they are a non-primary residence, so second home, vacation home, rental home, if they are an income-producing business, or if they are a 1 to 4 family severe repetitive loss property. There are other provisions of Biggert Waters that are going to continue to move forward. As far as modifications and changes that will be implemented under the Homeowners Flood Insurance Affordability Act that was just signed March 21st, we can tell you at this point in time that under that act, they repealed Section 207, which again is that section that talks about phasing out the discounts for property owners that have been newly mapped into a special flood hazard area and we're getting discounted policies in some form or fashion. The Homeowners Flood Insurance Affordability Act of 2014, we also know that beginning May 1st of 2014, and May 1st is the date because we have to give the Write Your Own companies an opportunity to adjust and adapt their systems of record to accommodate the changes under the new legislation that was signed on the 21st of March. But we know that beginning May 1st of 2014, those policyholders that were required under Biggert Waters Section 205 to be full risk rated using an elevation certificate, beginning May 1st, we will be reverting them back to pre-firm subsidized rates based on the October 1st, 2013 rate table. Refunds for those policyholders that are specifically called for under that new piece of legislation will be forthcoming, but we don't have the details for that yet. So we can't tell you much about that at this particular point in time. So policyholders, though, will continue, if it was a benefit to be full risk rated, they will be able to continue to be full risk rated instead of taking the subsidized premium, because for some of them it turned out to be a benefit, but for those where it presented an economic challenge and it's cheaper for them to take the pre-firm subsidized rate, they will be able to be converted May 1st, 2014 or after. So, and the agents and the underwriters and the Write Your Own companies, they will be implementing that. A lot of the details are on this Write Your Own bulletin that's in the back of the room there. I would say that really, if you pick up a bulletin, you want to focus on the first page and the back page, because that really provides a summary in a nutshell. The rest of the bulletin is pretty detailed, pretty complex, and pretty confusing unless you're an underwriter or you're an insurance agent or an actuary and understand the jargon that they're talking about in the rest of that memorandum. But the first page, back and front, very, very good synopsis. Okay, so what else do we want to talk about? On the Biggert Waters website, there is a great overview that talks about the Homeowners Flood Insurance Affordability Act of 2014 in general. It's there for anybody who wants to look at it. It's a great document to refer property owners to that have questions about the new legislation. So I wanted to let you know that that was there. This really has nothing to do with the reform legislation. It does and it doesn't, but I wanted to let you know that every year the underwriters and the actuaries with the flood insurance program, they review the rate structure and they adjust the rates according to loss history and a number of other elements. So some of the rates will go up, some of them will go down, but they're adjusted annually every year. So independent from any of the flood insurance legislation that we have on the horizon, either the Biggert Waters or the Homeowner Flood Insurance Affordability Act, there are annual rate increases that you may get calls on. And we had some significant increases October 1st of 2013 that impacted policyholders in general, independent of the legislation. And I wanted to make you aware of those because you may get calls from property owners who get this confused and say, well, I'm getting the rate increase because of the new legislation. Maybe they are, maybe they aren't. It just depends on whether they fall under something that was a trigger under the legislation, or whether it just happens to be that they fall into a rate category that saw an annual rate increase as a result of a program review. These rate increases are also, they come out in bulletins, write your own bulletins that are posted on the National Flood Insurance Program website, so you will see these. They're available for public viewing. June 1st of 2014, there are some other provisions of the Biggert Waters legislation that are moving forward, irregardless of the Homeowner Flood Insurance Affordability Act of 2014 that I wanted to make you aware of, because you may hear about these things, and I think what you may hear is, well, the Biggert Waters flood insurance reform legislation of 2012, it has been repealed completely. Some of it has been repealed. Some of the provisions, many of the provisions are still moving forward as planned. So, so there are some insurance provisions that I wanted to let you know that will be moving forward. And these are part of the Biggert Waters legislation as originally signed on July 6th of 2012. So beginning June 1st of 2014, if you have an apartment building, previously you can only purchase $250,000 of coverage on each apartment building. Beginning June 1st of 2014, under Section 204 of Biggert Waters, you'll be able to purchase up to $500,000 for each apartment building. These are other residential, so these are residential buildings where there's 5 or more units, and these are people's residences. The primary residence we talked about already, where that will be adjusted from 80% down to 50%. So if the insured or the insured spouse lives there less than 50% of the time, beginning June 1st of 2014, it will be considered to be a non-primary residence. So that's being adjusted. Also, we're publishing a new minimum deductible schedule under Section 210 of Biggert Waters. So if you have a certain amount of coverage, up to $100,000 in certain flood zones, you will have a standard deductible of X. If you have flood insurance coverage over $100,000 in flood zones X, Y, and Z, there will be a different standard deductible. So that's being implemented June 1st. Maximum coverage clarified, we probably don't need to go over that so much. Policy disclosure, under Biggert Waters Section 234, you won't get calls on this, but I'll throw it out there. They are increasing some areas of the flood insurance policy font. So the font will be bigger. Unfortunately, that also means that the flood insurance policy form itself will go from a 19-page read up to something like a 46-page read. So the font will be bigger, but so will the page count. So that's happening June 1st. And we will still continue with our discussions on reducing the actual risk, because the primary goal of the National Flood Insurance Program really is not to see how high we can take the premium before it breaks the piggy bank. It's really the preservation of lives and property, and to reduce people's risk of being flooded and those consequential damages. So we still want to have those conversations about how can we reduce people's risk. So that's one thing about the Biggert Waters legislation. It has prompted a lot of good discussions on how can we help property owners and how can we educate them on what kind of mitigation actions can they take to make their buildings safer. If the building is safer, that usually correlates to less risk of flooding, which then correlates to a lower flood insurance premium. We are still in the same boat where the flood insurance program is not fiscally sound at the moment. It still is the only game in town, and the only other alternative with only a few private insurance carriers on the market selling flood is federal disaster assistance, which is, it's limited. Great that we have it, but it's limited. So Congress is still faced with the dilemma of trying to keep this program solvent and keep it available for future generations so that property owners that want flood insurance and need flood insurance can avail themselves to purchasing an affordable policy for flood insurance. So we are still having those discussions and will continue to have those discussions. With respect to communities, we're encouraging them to look at the community rating system, which is what we call CRS. The community rating system is a great program that was introduced in 1991 to encourage communities to do more than the minimum required to participate in the program. And it keeps dollars in the community, and it also keeps it a safer place to live for property owners. Communities who participate in the community rating system, they earn points for actions that they take over and above the minimum floodplain management requirements, and that equates to policyholder discounts for those communities who participate in CRS. So it's one way to help property owners stay safe, keep the dollars in the community, and also keep the flood insurance premiums low. So we also want to help communities understand and be able to implement the mitigation, take advantage of the FEMA mitigation program and any other types of programs that might be out there where they can get money for floodplain projects. And we look to them to provide technical assistance to property owners in the form of, you know, how do I rebuild my structure if it's damaged by fire or if I'm doing a major remodel? And with respect to securing elevation certificates, if they're curious to see what their full risk rate is. We're talking to real estate professionals, and we're educating them. We have always worked, they've always been a partner in this program, but we're encouraging them more and more to make sure that they identify the risk where for the property that's being sold, determine whether it's pre-firm or post-firm, and find out if it's been impacted by a recent map change, and to also look into what the flood insurance premium would be on that particular property, and to let the prospective buyer know what the risk is and know what the flood insurance premium is today and what it might look like in the future. So really, you know, again, to close the session today, I just really want to, you know, we have some key takeaways here, and really that's about the mitigation. We want people to, you know, understand what their risk is. We want people to be able to buy down their risk without breaking their piggy bank, so we want them to be able to buy flood insurance. And we want them to have the ability to be able to build safer, stronger, and smarter, so they're less at risk. We don't want to see people suffer the consequences of flooding. And we want to use all of our industry partners, the local communities, the insurance agents, the insurance carriers, the lenders, the regulators, all of those folks. We want to collaborate and communicate with all those folks because we have a lot of excellent expertise, and if we put all our heads together, we can come out with a fabulous product. So just some additional resources. Again, the flood insurance website for the reform legislation. If you type in flood insurance reform on the end, or if you type in BW12, you will get to the public-facing website that talks about all of the flood insurance reform legislation, and all of our bulletins are on there. If you haven't been to floodsmart.gov, this is another website that's really excellent for all of the stakeholders, the agents, the lenders, the community officials, and the property owners. It's easy to navigate. It's got links to everything you ever wanted to know about the flood insurance program. I absolutely love this website. So if you can't remember what the flood insurance reform website is, just go to floodsmart.gov. You'll get there, I guarantee you. And that is all I have. It's 4 o'clock, so I will leave it open for questions. Yeah.
Okay, I was just giving her a little bit of direction. I volunteered Maureen to help her get to somewhere to get dinner because we're on our way to the next public meeting with the citizens. And I wanted to thank Edie once again for coming because we're expecting to have one more training. Patricia Rippey with FEMA Region 9 is going to come in May, either through telepresence or in person, to talk about permitting issues, which is really important with the new maps coming in place. And I kind of wanted to open it up. Are there any questions specifically? Because the maps are coming in June. I know you guys are going to be affected, so.
I just had a question regarding, City of Maricopa's expansion with annexation. Are we going to include the extra land we are annexing right now? We're on the south side of Anderson. Lots of property out there. There's about 900 acres.
Yeah.
Is that something you're looking at providing us?
Well, there's existing floodplains out there. This remap only covered the 9 panels, I think, that were in the city of Maricopa limits at the time, which we started this project back in 2009. So the 9 panels cover all the city of Maricopa as it existed back at that point. And then the new stuff, there's already maps there, but it hasn't been updated. Any other questions real quick? What you can expect is increasing number of phone calls. The county has a website up for the project. It's got contact information on there. At the local level, you guys do all your building permitting here, and Josh Plum is kind of your floodplain resource here at the city. And what he knows is if it pops up in a floodplain, he's going to refer it to the county to get some help on it. We have to have all these documents when it's in the floodplain. And one of the questions we got at the Monday night meeting was, how come nobody told me this was being remapped? The maps you are handed show where the A zones are and which areas are affected. And I recommend if you have a customer come in and you just happen to notice they're in one of those new areas, that you let them know, because it's important to them to know. If they didn't get our mailers, and I think we sent out 2 rounds of 1,500 mailers apiece, trying to get out to people, postcards and letters, plus the website, plus the press releases, plus the newspaper, trying to get the word out, but still people might not miss it. So if you do run into a customer that doesn't know they're going into an A zone, that's what those maps are for, just to let you guys know. And strangely, the complaints we had yesterday most often were about the A zones that were already in existence, because people didn't know they were in an A zone. And when we got the mailer, they said, oh, wow, when did this pop up? And we had to tell them, well, a long time ago. So the second training will be more on the permitting side, and so that'll address those concerns. I just wanted to give you an introduction on the insurance, because it's so complicated. I'm going to be giving a briefing to our board, and I told our county manager, let me hear Edie's talk first, because I don't even know what to tell people. I'm so confused by the new legislation. So I appreciate your tolerance with an insurance talk for 2 hours. It will be important, so thank you very much.